This is Nightly Business Report with Bill Griffith and Sue Herrera.
Good evening, everybody, and welcome to this special edition of Nightly Business Report. Sue is off tonight. You know, believe it or not, we are halfway through 2019, so we're going to spend this evening looking at the outlook for the second half of the year for everything from the markets to the Fed to housing. And we begin tonight with stocks and the economy. This year, performance has been a bit bumpy. Stock rallies have given way to new highs, but there have been some sharp and severe slumps as well. And at the center of most of those moves has been the Federal Reserve. We have two reports on that tonight. To start with, we have Steve Leisman who will tell us what's ahead for the central bank. But first, Dominic Chu has the outlook for stocks.
After a blistering run for stocks in the first half of the year, here are three things to watch as the markets head into the back half of 2019. First, trade, deal or no deal. Despite the fits and starts over trade negotiations between the U.S. and China, investors have largely been optimistic that a resolution will come to pass. But what happens if things drag out? And we're not even getting into what happens if America decides to stir things up with other trading partners around the globe. Second, the Fed, to cut or not to cut. That is the question. At this point, markets are largely expecting that the economic data will lead the Federal Reserve to ease financial conditions by cutting benchmark interest rates. Will it push the stock market to record highs or signal weakness ahead? And third, mega cap stocks, specifically those in tech, communication services, and retail, like Microsoft, Amazon, Apple, and Facebook, just to name a few. They've had a lot of influence on the market rally, but will the threat of increased government scrutiny derail that trade? Just three of the big market themes to watch in the second half. For Nightly Business Report, I'm Dominic Chu.
For the second half of the year, the Federal Reserve will be focused on when to make a move on rates and how big a move to make. Here's what to watch. First, gauge the economy ahead of the meeting in July. Unless its strength is measurably from the 2% growth now forecast, cut interest rates. Second, how much to cut? Perhaps a quarter point with a few more in the months ahead, or perhaps a more muscular 50 basis point cut. The Fed could then pause for a few months while taking stock of the outlook for growth and especially for inflation to hit its 2% target. Third, when to stop. The Fed will be reluctant to do more than a few cuts. It holds exactly 9 quarter-point rate moves in its arsenal before the powder runs dry and it's back at zero. The Fed will want to avoid another long spell at zero interest rates, and it won't want to launch another round of quantitative easing, that is, expanding its balance sheet to drive down rates, unless it really has to. So look for some near-term rate cuts from the Federal Reserve, but they'll be limited unless the economy gets measurably worse. For Nightly Business Report, I'm Steve Leisman.
Let's turn now to a couple of guests for their outlooks on the economy and the financial markets in the second half. Christina Hooper is Chief Global Market Strategist at Invesco. Jim O'Sullivan is Chief U.S. Economist with High Frequency Economics. Good to see you both. Thanks for joining us tonight.
Thanks, Bill.
Great. Thank you.
First, your outlook. Christina, on the markets themselves, you expect some more volatility, don't you?
Absolutely. We have the potential for more in the way of trade disruption in the back half of this year. It doesn't look like the U.S. is going to change or stand down in terms of its trade aggressiveness. And Jim, you see a slower growth economy. How much slower?
Well, Bill, that's the question. And obviously there is a lot of uncertainty related to the trade battle in particular. I mean, over the last 4 quarters, real GDP is up 3.2%, which is a pretty good number in comparison with the cycle to date. But certainly there are reasons to expect slowing. So I've got it down to basically 2% in the second half of the year and 2% into 2020. But again, there's clearly a lot of uncertainty with the trade negotiations. And with the Fed, and I want to address the Fed to both of you because what the Fed does will have an impact on both of your forecasts. Christina, for example, I mean, both of you do expect the Fed to cut rates at some point. Christina, what are your expectations there? My expectation is that the Fed will cut rates at least once in the back half of this year, and I do believe that's a game changer. If we didn't have the Fed take a more dovish turn, I don't think we would have such a rosy outlook for stocks. But given that the Fed has made every indication that it is willing to get more accommodative, I think that's going to provide a put under stocks that should help them counter the kind of headwinds created by the ongoing trade conflicts. And Jim, you see 2 cuts coming, don't you? Yes. I mean, certainly at the last FOMC meeting, the Fed pretty much told us that unless the uncertainties, as they call them, related to trade developments disappear by the July meeting, at the end of July meeting, that they'll be easing. Now, how much remains to be seen. It depends on what the data do, what markets do, what happens on the trade front, et cetera. But I'm assuming a quarter point in July, another quarter point in September, and then assuming the economy is not weakening dramatically, the Fed stops there. But again, obviously it'll depend on the data and the backdrop in general.
Jim, is this because inflation is not getting up to the target that the Fed wants of around 2%, or why would they want to cut a couple of times, do you think?
Well, the immediate trigger recently has been to offset the potential drag, the downside risks, as Fed officials put it, from the trade side, from trade negotiations weighing on business confidence and the slowing in global growth and exports that we've already seen. So that's been the big change in the last couple of months. But there's no question inflation is part of the story. To the extent the inflation numbers have been weaker than expected, to the extent the Fed is really changing its strategy on inflation from what used to be called a bygones or bygones approach,
right,
where they just want to get inflation back to 2%, the goal. Now they really want to make up for missed inflation in the past and go a little above 2%. So when you put those two together, it's really made the Fed much more dovish here.
And briefly, Christina, on trade, you know, the longer this goes, the tougher it gets for companies to deal with the higher tariffs. What are your expectations on that?
My expectations are that companies are going to pull back in terms of CapEx spending, in terms of business investment. I think we've already seen that, and certainly the Fed has alluded to that. And that could continue and get worse as time goes on. That's what happens with economic policy uncertainty. When it goes up, business investment goes down. And of course, we have added economic policy uncertainty next year, given that we're heading into the 2020 presidential election.
Right. Christina Hooper with Invesco, Jim O'Sullivan with High Frequency. Good to see you both. Thank you for joining us tonight.
Thank you.
Thank you.
Meanwhile, movement in the U.S. market can sometimes be driven by what happens overseas. So we asked Seema Modi to take a look at the key issues ahead for the global market.
Elections, geopolitics, and trade will keep global investors on edge in the second half of the year. First, the volatile and drawn-out trade discussion between the U.S. and China will push even more American companies to shift production out of China, with countries like Vietnam, Cambodia, and India becoming bigger destinations for manufacturers, retailers, and technology companies. Second, expect Iran to become a bigger geopolitical risk. Further conflict between the U.S. and Iran could raise tensions in the Middle East, which accounts for 20% of the world's oil output. Any disruption to oil shipments could send prices at the pump much higher. To lessen the blow, U.S. energy companies will likely continue to build out infrastructure here to become less dependent on the Middle East for oil. Plenty of elections and changes to leadership expected in countries like the UK, Canada, and Argentina, but financial markets will focus on the race for Mario Draghi's job as president of the European Central Bank, perhaps the most powerful job in Europe. Any departure from Draghi's whatever-it-takes approach to saving Europe from a recession could disappoint investors. For Nightly Business Report, I'm Seema Modi.
Now, the two biggest sectors of the market are technology and the banks. And the first half was a volatile one for tech. That group either led the market higher or dragged it lower, while the financials, they just continue to struggle along. In a moment, Wilfred Frost will give us a breakdown of the banks. But first, Josh Lipton takes a look at what's next for big tech.
Even with the looming threat of a trade war, tech is the top performing sector so far this year. Here's what else to watch for in the rest of 2019. First, new iPhones. Tim Cook tells CNBC that the iPhone XR has consistently been his top seller, which is the least expensive of the phones launched last fall. And that means this fall, when Cook introduces his new lineup, he might focus more on mid-tier phones with new features, capabilities, and marketing dollars. 2, Jedi. The U.S. Department of Defense is deciding which company will win a big cloud computing contract known as Jedi, worth up to $10 billion. The winner could be announced as soon as August. Amazon and Microsoft are in the running. The winner could use the deal as a selling point, convincing companies in other data-sensitive industries, from finance to healthcare, to entrust it with their information too. 3, regulation. State, federal, and international regulators all have tech in their sights, including Alphabet's Google and Apple, Amazon, and Facebook. And that means there's little likelihood of approval for any big acquisitions. That could be a challenge as these companies hunt for growth and one their Chinese rivals don't face. For Nightly Business Report, I'm Josh Lipton, San Francisco.
Interest rates, credit quality, and whether the IPO bonanza can continue are the key things to watch for banks in the second half of the year. First up, yields. Banks typically like high rates and a steeply rising yield curve. That lets them borrow money at lower rates and lend it out at higher rates. They've got neither of those things at the moment. That means that even if a Fed rate cut does come, it might not be so bad, as it will at least steepen the curve, even though it will lower rates. And it should boost the economy, which will help the banks. Second, credit quality. Banks' own credit quality has remained robust despite fears of a slowing economy. There are also growing fears out there, though, about the huge rise in leverage loans and direct lending. But this isn't so much an issue specifically for the banks. As Federal Reserve Chair Jerome Powell recently stated, the Fed feels that banks are in a good place and they're more concerned about the non-banks that have made those sorts of loans. Third, the IPO bonanza. Q2 was very strong for IPOs, which boosted the investment banks. M&A also picked up towards the end of the quarter. Can that continue and help the likes of Goldman Sachs and Morgan Stanley? For Nightly Business Report, I'm Wilfred Frost, New York.
The healthcare sector, as it happens, was the best performing group in the stock market in 2018, but things certainly reversed in the first half of 2019. So now investors want to know if the sector is ready to rebound. Bertha Coombs takes a look.
Regulatory pressure from Washington will continue to loom large for the healthcare sector, with the Trump administration now taking up transparency on hospital prices. In the next few months, analysts say watch for the administration to finalize its drug price blueprint policies, including a ban on pharmacy benefit rebates for Medicare drug plans and potentially pegging some Medicare drug prices to international rates. Policies proposed in the last year, just after drug makers raised list prices.
If you assume that drug companies are going to raise list prices again the beginning of July of this year, then we can assume the administration is going to do what it did the last two times, which is issue additional regulations immediately thereafter.
Outrage over high drug prices hit pharmaceutical stocks hard during the last presidential election cycle in 2015. This time around, health insurers have been hit hard, following Senator Bernie Sanders' campaign launch in February and again in April after the senator reintroduced his Medicare for All bill, which was endorsed by presidential hopefuls Kamala Harris, Cory Booker, and others. Analysts in Nephron Research say stocks found their footing after Joe Biden entered the race. The frontrunner is not seen endorsing single-payer health care.
If you were to see one of the candidates, like Bernie, who believes in a Medicare for all and believes in really getting aggressive on drug pricing, take the lead, at that point, I think you would see negative impact on healthcare stocks going forward.
On the fundamental side, the major insurers have all forecasted stronger earnings in the second half, which also helped stabilize their stocks over the last month. But it may be tougher for them to move higher amid the regulatory and political pressure they'll face this election cycle. For Nightly Business Report, I'm Bertha Coombs.
And still ahead, will the second half be a turning point for the housing, retail, and airline industries? Now to a few consumer-related sectors. First, retail. It's no secret that the industry has generally been struggling to keep shoppers happy and to compete effectively with online competition. While some companies have achieved the right combination of brick and mortar and online, many others have not. As a result, the outlook overall is still a rocky one. Here's Courtney Reagan.
The first half of 2019 has been rough for retail, but with back to school and the holidays, the second half matters more, and the unknowns are piling up. First, tariffs and trade. Many retailers have been working for years to move manufacturing out of China, but it's still the #1 sourcing location for U.S.-bound clothing and shoes. If a new round of tariffs hits those categories, shoppers may face even higher prices at retailers like Macy's, American Eagle, and Steve Madden, just in time for Christmas. Second, shipping wars. Walmart, Amazon, and Target are all racing to deliver faster. Amazon spending $800 million in just one quarter to get closer to one-day shipping for Prime members. Walmart is expanding one-day free shipping without a membership to more cities as the year goes on, and Target is offering same-day shipping for $10. Third, store closures. Around 7,000 store closures have already been announced this year, outpacing all of 2018. Coresight Research projects that total closures could hit 12,000 by the end of the year, opening up opportunity for those left. For Nightly Business Report, I'm Courtney Reagan.
For many, buying a home is the largest financial transaction that they'll make in their lifetime, and that's why so much attention is paid to the health of the housing market. But this year, the typically hot spring market was cool, and homeowners want to know if that will be the case for the rest of the year. Diana Olick takes a look.
Mortgage rates, home prices, and supply could all make for a meaningful change in the pace of home sales in the second half. Mortgage rates have been falling steadily since the start of this year. The 30-year fixed was just above 5% last fall. Now it's below 4%. Lower rates are already bringing out buyers and increasing competition. If rates stay this low or lower, we could see a big sales boost in the second half. But that will juice prices again. The big gains in home prices were shrinking pretty dramatically in the first half, but made a U-turn in May, suddenly gaining again. That's thanks to lower rates, which help buyers afford more. At some point, though, affordability kicks in, and even lower rates won't help buyers, especially first-timers. That's what happened in the spring of last year. The only thing that could help would be more supply. Housing starts have been very weak so far this year, but builders say they are starting to pivot to cheaper entry-level homes, exactly what the market needs. For Nightly Business Report, I'm Diana Olick in Washington.
Cheryl Young joins us now to talk about her outlook for the housing market the rest of the year. She is senior economist at Trulia. Cheryl, good to see you again. Thanks for joining us tonight.
Thanks for having me.
Home prices have been going up, but you're sensing a slowdown in that price increase, yes?
That's right. Since the beginning of the year, and I think what we're going to see through the rest of this year is that continued slowdown in price appreciation. We're not talking about price dropping yet, but we are seeing a slowdown and possibly a flattening through the rest of this year.
Even with interest rates going lower, mortgage rates now are, what, 2-year lows at this point. Is it because demand is going to go down, or what's going on there?
No, that's right. So mortgage rates are low, and that's actually going to help drive demand. It's going to bring more people back into the market as mortgage rates go down and stay down. But what we're seeing is that we've really hit sort of an affordability ceiling. Price growth has far outstripped wage growth over the past several years, and that's just simply not sustainable in the market right now. So people have been very hesitant to come back in. But with that softening of prices and also low interest rates, hopefully we'll see more people, especially those first-time home buyers, coming back into the market.
And it is well documented that home builders aren't keeping pace with demand because it's just too expensive. The supplies prices are up, and labor is tough to find these days, right?
That's true. Labor costs are really high. There's a shortage of labor in the construction field, and right now it's very difficult to build housing. So while demand is there, it doesn't really make sense for a lot of builders, especially to build that sort of affordable housing, which is what we're looking for. And it is going to be tough to get that supply up for all the demand that's been pent up over the past few years.
You know, we talk about how tough it is for home buyers, even with these low interest rates, but it's not a picnic either for home sellers these days, is it?
It isn't quite what it's been for home sellers. Home sellers have really had the upper hand, I would say, in the past few years just because of that low supply and that price appreciation. They're not quite in the driver's seat anymore, and that isn't necessarily a bad thing because there are still a lot of people out there looking for housing, but they certainly shouldn't expect quite the market conditions that they're used to.
Will it take longer to sell a home, do you think, as a result?
yes, we've actually seen that homes have been sitting on the market a little bit longer, and that's going to probably continue as we've seen some supply coming back onto the market, and that's going to be a little tougher for sellers who've really seen sort of homes fly off the shelf. But like I said, I think we still have a lot of pent-up demand, especially among the first-time home buyers. So it's still a healthy market out there. It's just slowing down a little bit.
Cheryl Young with Trulia, again, thanks for joining us tonight.
Thank you.
Elsewhere, a record-breaking number of Americans are traveling over the 4th of July holiday. Nearly 49 million are planning a getaway. According to AAA, the majority will travel by car, while many others travel by plane. Tonight, Phil LeBeau tells us what's in store for both of those sectors.
In the second half of this year, airlines and investors will be focused on international markets, keeping up with demand, and the return of the MAX. Boeing 737 MAX is expected to be flying by the end of the summer, but that's not a sure thing, and any further delays could have a ripple effect on the entire industry. With so many MAX planes grounded, airlines are pushing hard to keep up with demand. One area where some airlines are seeing softness, international routes. That will be a focus for large international carriers in the second half of this year. For the auto industry and investors, the second half of the year is about tariffs, sales, and potential merger deals. On tariffs, the big question is if the U.S. puts a tax on vehicles imported from Europe. If that happens, it could impact sales, which slowed slightly in the first half of this year. And don't be surprised if Nissan, Renault, Fiat Chrysler, and other automakers revive the idea of potentially merging operations. That could rev up auto stocks in the second half of this year. Phil LeBeau, Nightly Business Report, Chicago.
And another consumer sector is entertainment. That industry is undergoing some very big changes, and as Julia Borston reports, there could be more to come.
As we enter the second half of this year, three things for media investors to watch are consolidation, streaming wars, and the box office. First, consolidation. More media deals are expected ahead with a focus on Viacom and CBS. Sources tell us they're in talks now. And Lionsgate's Starz is also on the block, as that studio and other smaller players feel pressure to compete with the recently merged giants. Second, the streaming wars will get their biggest new entrants in years. Disney Plus, Apple TV Plus, and a beta version of AT&T's Warner Media Service, all set to launch before the end of the year, putting pressure on consumers to choose and putting pressure on the cable giants to find ways to hold on to their customers. Third, the theatrical movie business will be put to the test. The domestic box office is down nearly 9% from last year. The question is whether huge franchises hitting theaters, Spider-Man, Lion King, Frozen 2, and a new Star Wars film turns that around, or whether franchise fatigue and the option to stream at home weighs on results. For Nightly Business Report, I'm Julia Borston in Los Angeles.
And coming up, now that you have an idea of what's ahead in the second half, what should you do with your money? Some advice coming up. Now that the first half of the year is behind us, how should investors prepare themselves for the remainder of the year? Joining us tonight to talk about that, Diane Lassus. She's co-founder of the wealth management firm Lassus Worley. Always great to see you.
Great to be here.
Thanks for joining us tonight. Where do we begin? I mean, I'm thinking of a lot of our viewers want income from their investments.
Right.
Depending on where rates are going, it gets tougher and tougher to try and find income, isn't it?
You really have to look for total return, which means you have to have that equity exposure in order to get any kind of real long-term return to generate that income and cash flow.
And cash flow is one thing you should try and keep tabs on and make sure it's aligned with your investments as we go into the second half of the year, right?
Absolutely. You need to look and see what your needs are going to be over the next 6 to 12 months and make sure you have cash available, especially for emergency needs.
The risk level of your portfolio, how do you assess that?
you really look at your allocation based on how much exposure you have to the equity markets, because that's going to drive risk, volatility, and obviously long-term return.
And then we often talk about rebalancing. You do that periodically, you know, trim some of the losses or gains at this point. Is this a good time to be doing that?
Absolutely. Rebalancing is very important right now because we want to stick to that buy low, sell high adage. So now's a great time to be taking some profits in that equity market and not leaving that money out on the table.
Does it matter to you as a financial advisor what the Fed's going to do? I mean, we just had a couple of analysts on here who see at least one, maybe two interest rate cuts before the end of this year. What does that do to the people looking for that income still?
It doesn't help them an awful lot, because that means the bond side of the portfolio is going to have lower flow in terms of interest payments. That also means they need to look at their overall portfolio and figure out what kind of return they need over the long term in order to meet their cash flow needs.
You know, when I began my career, people were desperate to try and stay ahead of the rate of inflation with their investments. That's not so hard to do these days. Is that still a bogey for you to try and stay ahead of inflation with your portfolio?
Absolutely. It's still important, and we don't know that inflation's disappeared for the long term. We could still see it raise its ugly head down the road. But for right now, it's more about risk management in terms of your overall portfolio.
Diane Lassus with Lassus Worley, thanks for stopping by.
Thank you.
Appreciate it. And thank you for stopping by and watching this special edition of Nightly Business Report. I'm Bill Griffith. Have a great evening. See you tomorrow night, and happy 4th.